This is BD Daily Finance News Podcast, your daily briefing on finance and investing. It's 2026, March 5th, and today's market root is oil is yelling, bonds are listening, and stocks are quietly reconsidering their life choices.
I love when the market has feelings. Oil is yelling, yields are climbing, and my portfolio is doing that thing where it pretends it doesn't know me in public.
We'll cover three big threads. First, Treasury yields hitting weekly highs as inflation risk mounts. Second, stocks sliding as oil advances. And third, what the Fed says it's watching if this geopolitical shock lasts.
Gas gets expensive, the bond market gets dramatic, and the Fed does the "we're monitoring the situation" face. Let's go.
Story 1. Treasury yields reached weekly highs as markets worried that higher crude oil could feed inflation. When oil rises, investors start asking, will prices re-accelerate, and will rate cuts get delayed?
So the bond market is basically that friend who hears one rumor and immediately cancels the whole weekend. Oil's up? Cool. I'm raising yields and texting my ex. Inflation.
Here's the simple version. A treasury yield is the interest rate the government pays investors. If investors fear inflation, they demand higher yields to keep their real return from getting eaten by higher prices.
It's like lending your friend $100, but if they pay you back in future dollars that buy less pizza, you're like, fine, add interest and maybe a pizza protection fee.
Why it matters for normal people. Higher yields tend to push up borrowing costs across the economy. Mortgages, auto loans, credit cards, those rates don't move one for one, but the gravity is upward.
So if you were planning to refinance, the bond market just said, not today. And if you carry a credit card balance, congratulations. You're now sponsoring the concept of higher for longer.
Actionable takeaway. Run a quick rate sensitivity check. If you have variable rate debt, prioritize paying it down. If you're investing, remember that higher yields can pressure high valuation growth stocks because future profits get discounted more heavily.
Discounting is just the market's way of saying, I don't trust future you, which is fair. Future me has a lot of tabs open and no plan.
Story 2. U.S. stocks slid as oil advanced and yields rose. Classic squeeze. Higher oil can mean higher costs for companies and consumers, and higher yields tighten financial conditions at the same time.
It's like your paycheck didn't change, but your rent went up and your grocery bill went up, and your gym still charges you even though you haven't gone since. Never mind. That's the corporate version of margin pressure.
Finance behind it. Simple analogy. Think of the economy like a delivery company. Oil is the fuel bill. If the fuel bill spikes, deliveries cost more, and either prices go up, profits go down, or demand drops because customers pull back.
And investors hate the choose-your-own-adventure, where every ending is slightly worse. Do you want inflation, lower earnings, or a consumer tantrum? Yes.
What to do with that as an investor? Don't confuse volatility with a required decision. If your plan is long-term, consider rebalancing instead of reacting. Trim what's run up, add to what's underweight, and keep position sizes sane.
Rebalancing is the grown-up version of, I'm not panicking, I'm just moving the furniture so I can exit the room faster.
Also watch second-order effects. Airlines and shippers feel fuel costs quickly. Some energy producers benefit from higher prices. But remember, energy stocks are still businesses with their own risks, not magic hedges.
Energy stocks are not a force field. They're more like an umbrella, helpful in rain, but if the wind is insane, you're still getting hit in the face.
Story 3. Fed messaging. Richmond Fed President Tom Barkin said the Fed response to the Iran war shock depends on how long the impact lasts. That's a key phrase, duration.
The Fed is basically asking, is this a pothole or is this the whole road missing? Because if it's the whole road missing, they might stop talking and start doing.
Exactly. Central banks tend to look through short-lived supply shocks, like a brief oil spike, if inflation expectations stay anchored. But if higher energy costs persist and bleed into broader prices and wages, policy gets harder.
So the Fed's nightmare is when gas prices show up everywhere. Like, suddenly your haircut is more expensive because the barber's scissors are energy adjacent.
Practical watch list for listeners. Keep an eye on oil staying elevated and on yields staying elevated. If both remain high, markets will keep questioning near-term rate cuts, and rate-sensitive sectors can stay choppy.
And for regular humans, if you commute, update your budget assumptions. If you're shopping for a home, don't fall in love with a payment you can't afford if rates don't cooperate.
Quick recap on 2026 March 5th. Oil-driven inflation fears pushed yields higher. Higher yields plus higher oil weighed on stocks, and the Fed is focused on whether the shock is temporary or persistent.
And your move is not predict the next headline. Your move is protect cash flow, reduce variable rate pain, and rebalance like an adult. Emotionally, I mean. Financially too, if you can.
If you want more of this daily briefing, subscribe and leave a review. And in the comments, what's your one indicator for this oil spike is becoming real inflation? Gas prices, shipping costs, or something else?
Also share this with a friend who says, I don't follow markets, and then immediately tells you what oil did overnight. See you next episode.